So welcome back, everyone. This is our last session for today. With me to discuss ways to increase retail participation in capital markets are 5 very familiar faces who need little introduction. We have Gabriel Bernardino, chair of EIOPA, Sheila Nicoll, head of public policy, Schroders, Panova, head of unit, CNU, DG FISMA, Commission, Guillaume Prache, managing director of Data Finance, and Thomas Richter, chief executive officer at the BVI. Many thanks to all 5 of you for accepting to share your views and answer questions from the audience. Questions can be put to the panelists using the chat function in Hopin. When preparing for this session, we thought we would divide it into 2 parts. First, we will debate what is holding savers back from investing in capital markets. Despite interest rates being close to 0 and the value of their hard-won savings being eroded by inflation, a very high percentage of households do not invest in capital markets instruments and choose to stay in bank deposits. Not much progress has been made over the last years, as evidenced in a report EFAMA recently published, and of which some charts were shown during the break. In the second part, we will discuss what can or must be done to improve the overall investor experience, looking at issues such as disclosure, value, distribution, and advice. But first, we thought we would ask you, Tanya, what has been the reaction of the European Parliament and of the member states following the adoption of the new CNU action plan of the Commission? As you know, EFAMA is very supportive of the CNU initiative, and so are most, if not all, of the other European trade associations. But what we need now is strong political commitment. So the question, Tanya, is there real political will to make substantial and decisive progress towards CNU, especially in the member states? Can you feel it, and are you optimistic?
Thank you very much, Tanguy. Good afternoon, ladies and gentlemen. I'm really happy to be here with you today. So, Tanguy, you're asking me whether I'm optimistic. In short, I would very much like to be. I would like things to be different this time. We absolutely need to see signs that member states, but also Parliament, are willing to work constructively this time, also on difficult files. As I keep saying everywhere, we need to make progress on all files, not only on some and not only on the highest priority ones. Overall, I am optimistic because COVID and weakening balance sheets of corporates give more prominence to market-based equity financing. No progress on CMU would undoubtedly mean slower recovery, and that is going to cost jobs across member states. This is a too high of a price to pay. Hence, member states have no other choice but to get serious about CMU this time around. However, as usual, the European Parliament continues to show its strong and unwavering support to the project. The own initiative report adopted by the plenary in October is very long, goes into pretty much every area covered by the Commission Action Plan and far beyond. However, the support is not even across all difficult files either. For example, the Parliament asks the Commission to make a stronger commitment to achieving real progress on difficult files, including insolvency laws, but then only invites progress on making national insolvency proceedings more efficient and effective, stopping short of inviting the Commission to work on rendering them also more convergent or harmonized. Another example is pensions, and we will talk more about this undoubtedly complex and sensitive topic in a moment. Here, the Parliament, while underlining the need to promote pension provision, particularly when it comes to second and third pillar pensions, and acknowledging the massive demographic challenges that the Union faces, only decides to welcome the pan-European personal pension product, which is undoubtedly extremely important, but was actually agreed upon under the previous legislature. Staying, therefore, entirely silent about what the Parliament thinks about the Commission's actions on pension adequacy and auto-enrollment in the new action plan. And this is probably not just an omission on the Parliament side. Moving on the member states, the ongoing discussions on future Council conclusions on CMU that will be adopted by the December ECOFIN show that not all member states are on the same page, and that some continue to be more enthusiastic about the project than others. We also see that difficult files still remain difficult. Somewhat unfortunately, COVID also gives a perfect excuse to focus on actions that can be achieved more quickly. And that clearly does not cover the big tickets, such as insolvency, tax, or pensions, for that matter. The word subsidiarity also comes up fairly frequently, and while being very appropriate in some cases, should not be used as a shield against any possible work on structural reforms at EU level. So coming back, Tanguy, to your question, am I optimistic? Yes, I am. Am I convinced this time things will be easier or different? Let's see. Time will show. Thank you.
Thank you, Tanya. Guillaume, Thomas, do you share Tanya's cautious optimism?
Well, I would like to share it, as we are very fond of the project and very fond of the Capital Markets Union and what has been proposed by the Commission so far. Germany has been among the countries that have been less enthusiastic, as Tanya called it a couple of seconds ago, at the very beginning. That has changed. I think this cautious attitude against CMU came from some concerns from the banking sector, who feared that that capital-based financing would overpower credit-based financing, which is their core business. I think that has disappeared rather quickly. So altogether, I think there is a very, very positive attitude in my country towards the CMU project. And as for the asset management industry, we have always welcomed this project. I mean, one of the core objectives of the CMU is to bring together capital demand and supply. And who else than us should be in the middle of that? And that is our core occupation. So this is why we have been very, very enthusiastic about it from the very beginning. For the time being, I think the project needs some prioritization. There are too many open issues, too many different construction plans, from prospectuses to MiFID. I think one of the priorities should be the single access point. That would be really, really important for one single capital market and cheaper access to data in particular. And another focus should be on voluntary opting out models in second pillar pensions.
Thank you, Thomas. Guillaume, any quick reaction?
Good afternoon. First, let me thank EFAMA for inviting a representative of individual investors to this very interesting debate. The title of your panel was, I think, Utopia or Necessity, to get individual investors more involved in capital markets. I think it's an absolute necessity, because it's the main pot of funding for the European economy by far, the main pot of net savings. So if it stays in bank accounts or capital guaranteed products, CMU will not work, not only for us investors, but for the economy. So it's not an utopia, because we know what to do. We need political will. Unfortunately, typically I'm an optimist. If not, I would not be doing the job I'm doing. This time I'm a bit pessimistic, because the most critical recommendations of the high-level forum on the Capital Market Union from June on retail investments to channel household savings more into capital markets have not afterwards been endorsed by the Commission in its action plan on conflicts of interest at the point of sale, on employee share ownership, on collective redress for individual investors, or on the key information documents. One hope is that at least the Parliament, the Econ Committee of the Parliament, did endorse the recommendation on employee share ownership as a very powerful tool to revive equity culture in the European Union.
Thank you. So let's move to this inertia from savers who seem to find it very difficult to invest in markets. So what is holding them back? And most importantly, what can be done to move the dial? Before discussing the important role of pensions, let's focus a bit on the obvious lack of equity culture in most European countries. Is this because of a lack of financial education, a lack of trust, or are people simply risk averse? What is your take on this, Sheila?
Thank you, Tanguy, and good afternoon, everyone. And it's great to be part of this very distinguished panel. So thank you very much for inviting me. I think the answer is yes to all your questions, but I'll carry on talking. I think we actually, taking a step back, it's not just about not having an equity culture in Europe. We don't have a culture of talking about money. I mean, it's almost acceptable in European cultures to say, I don't understand personal finance. So, you know, that's the fundamental problem we've got. And I think it's particularly because other people have done the worrying for us. In a world of state and defined benefit pensions, other people have taken the risk for our future well-being. But actually that is having to change fast, and we'll be getting onto that subject further on. So the starting point really is that we've got to get people engaged. We've got to get them talking about money. I do prefer the word engagement to education because people, when you talk about education, you tend to talk about children. Whereas actually what we need to do is to get adults engaged as well. And also adults tend to be put off if you talk education to them. It's about information, it's about guidance, it's about advice. And I think we'll come back to the question of advice. I think the good thing is that we do, coming back to your, is there a lack of trust? I think there is a lack of trust. But I don't think it's a lack of trust based on bad experiences. It's a lack of trust based on not really understanding what we do, particularly in the asset management world, or albeit that we get wrapped up with, well, you're all the same, aren't you? You're financial services. But it's not necessarily because people have had bad experience, but it's also due to lack of confidence, scared of looking stupid. We at Schroders do a global investor study every year, and we ask questions of 23,000 investors across 32 global locations. Interesting, this year, 97% of the respondents said they wanted a higher level of understanding of personal finance. But interestingly, they said they wanted it not necessarily to do it themselves, but they wanted to be able to probe an advisor or ask questions of an advisor. So we thought that there is clearly an appetite out there. But above all, it seems to me to be about a question of understanding the nature of risk. And we've got to get over that actually it's the risk, there is a risk in not taking risk. And we've also got to get over, if people are worried about volatility, volatility only matters if you need your money tomorrow or if you need it in the very short term. So we need to understand the need to ride out volatility in the long term. So yes, we do need to take a long-term view in terms of educating future generations, but we need to engage people now. We need to do that through better support and advice. And we as an industry need to talk to people in their own language. We need to reach out to them and not expect them to talk our language. And I think the final point I'd make is we've really got to grab them and engage them at moments in their life when they're willing to engage. One of the most successful examples of engaging investors that I've heard of was actually when information was given to women by midwives when they were pregnant. And that is a point in life where you're interested, you're thinking about the future, and you're willing to and desirous of engaging in financial matters. And I think that's going to be, it's key. It's not all about legislation, and we'll no doubt come back to that. But I think we need to find innovative and creative ways of engaging people at moments in their life when they're open to being engaged with. So those are my initial thoughts.
Thank you, Sheila.
May I comment on what has been said? Okay, I think there have been, from my perspective, there were three important topics. The first one is the language. Sheila, you complained that we don't talk in a language to our clients that is their language. I cannot agree more. You do it in English, we do it in German, but we use English terms. It's even worse here. So the way we talk to our clients must definitely be improved. We use words that, except from us, people don't understand. So I fully agree with that one. Then secondly, engagement and education, literacy, or whatever you call it. I mean, we are discussing the fact that people do not know enough about the functioning of financial markets and their investments. And I can tell you that we have a very successful program here that goes to schools. It is asked by teachers. It's not sent to teachers. They are requiring it. They ask us to get the information. We have printed more than 1.5 copies now, and that's why I say it's really successful. On the other hand, it's a drop of water on a hot stone. It's nothing. As long as it is not part of the curricula in schools, it's a pain. It's a pain for politicians who are responsible for education, but it's unfortunately not more than that. And talking about the curricula, I can tell you a little story of my personal experiences with that. There are two teachers' unions in Germany, one leftist and the other one is very leftist. And we talked to the very leftist ones and we told them, listen, that is an issue, that is a problem. And that is active consumer protection, by the way. Better understanding of what is going on and what people should do for their pension. And the guy responded, listen, Thomas, I understand what you say, but we do not want to educate capitalism. That's where we are. So I'm not confident that we will have any change or bigger change in Germany and so far. So that's why, third topic, it all comes down to engagement. And that's why I think the best way to engage investors, to engage people, is the pension again. We see this in the United States. We see it with the IRAs and the 401k plans. That makes people that been interested in their pension. And then they want to know what is going on. And that's why the level of education there, or the level of knowledge, better said, you're right, education is not a good word. The level of knowledge is higher there than here, even though it's not so great as some people pretended, but it's definitely better.
And people are willing to talk about money. I mean, you sit around a dinner table in America and people ask you, you know, what are you invested in? How are your investments doing? I mean, my best story is that I actually handed over my passport to an immigration officer at Dulles Airport once. And he asked me the reason for my visit. And I said I was coming into the United States to go to a conference. Oh, what kind of conference? Oh, it's a mutual funds conference. He said, now I've got my money in an active portfolio at the moment. And I'm just thinking whether I actually ought to put it into passives. Yeah. Imagine having that conversation with someone in Europe, an immigration officer.
You wouldn't do it here. No.
We are going to talk about pensions in a moment. Guillaume, do you want to react to what you heard?
Yes, I have not so nice stories to tell about this, I'm afraid. I agree with Sheila on the notion of risk, but it's like all the other points discussed. Yes, EU citizens as investors have a low financial literacy level. We all know that. And also a lack of equity culture in the last decades, but they are not the only ones. I think policymakers, the retail distributors suffer from the same problem. And the risk aversion, when you look at the institutional portfolios, is higher for institutions than for if you look at the assets of retail investors. So equity, there are two, I mean, there are a lot of important things, but to stress what has not been stressed so far is equity culture and trust. Equity culture, I agree with the comments, it's not education, because adults, you will not get them back to school for financial or investor education. The only time adults go back to school is to get a driving license, because otherwise they can't drive. They are not allowed to drive, but they can get financial products without a license. So the only two ways to revive the equity culture for adults is the point of sale, the retail point of sale, and it is the workplace. And at the retail point of sales, the instruments that are closest to capital markets are simply not talked about, not promoted by the retail distributors, because their incentives, commissions, inducements, however you like them, are on package products. Not, for example, on low-cost index funds, on stocks, on listed stock and bonds. So even the retail distributors, they don't really know what are stocks and bonds, because they never sell them. They never talk about these as instruments. Thomas was saying, you know, about the IRA. The IRA in the US, I have one because I worked in the US. I can invest directly in listed shares and stocks as well as in funds, which is not the case, although we thought about this for the PEP, for example, for the Pan-European Personal Pension. So that's for the point of sale. For the workplace, you know, all the statistics, the studies shows the power of employee share ownership to be promoted at the workplace, not only directly. You know, in the US, assets in SME stocks, in unlisted stocks, for a country that has half our population, is 100 times higher than in Europe. That's the direct effect. The indirect effect, you have, for example, a study in the UK that shows that people who have been exposed to employee share ownership programs at their employer, half of them are opening brokerage accounts. So that is working directly and indirectly. It's very powerful. Last thing I'd like to say, it's on trust. Again, at the retail point of sale, we do have a serious problem of conflicts of interest, and we need to face it. According to ESMA, for example, if I take low-cost index funds, it's a 50-50 market in the US, retail versus institutional. According to ESMA, in Europe, it's 10-90. So you have to ask yourselves why. And when you see the Wirecard scandal in June, after the recommendations of the HLF-CMU of including individual non-professional investors in collective redress scheme, and it is still nowhere and not in the action plan of the Commission. So that is why I'm a bit pessimistic, as I said at the beginning, but the tools are there, we know them, it's just political will.
Thank you, Guillaume. We will talk about advice, distribution, inducement, and those issues later on. But let's move on to pensions. Gabriel, I cannot think of anyone better than you to tell us about the retirement savings gap and pension policies in Europe. So do we have an issue here? And if so, what do you think must be done for the second and third pillars?
Well, thank you very much for the invitation, and thanks for, of course, for EFAMA for having a lot of cooperation along these years, well, also with us at EIOPA. Now, it's clear that we have an issue of low pensions coverage and low adequacy, and this is something that is in there for many years, and I think we need more and more political courage to and willingness to deal with it. And the work that we're doing within the CMU, I think, can be really a good opportunity. We have seen, of course, this going worse and worse years after years, because there's been, of course, in the last 10 years, let's say, a lot of, I would say, reforms on the first pillar pensions to address the challenges that we have of demography, of sustainability of public finances, etc. But we didn't have the same level of, I would say, attention to the development of good supplementary pensions, be it second or on third pillar. We have this incredible number. The coverage of supplementary pensions throughout Europe remains inexistent or than half of the member states of the EU. So this is really, I would say, not only an economic but also a social issue, and we need to make this mainstream. And I think we have transformed climate change in a mainstream area. We have seen the Green Deal. I think we should all fight to have also a retirement savings deal throughout Europe. We need to get this more mainstream. Now, is it possible? Can be done? I think so. It can be done. And I'm happy that a number of things are already included in the action plan from the Commission, also for following the high-level group report. The auto-enrollment is fundamental, and we need to discuss it. It is politically sensitive. Yes, it is. We know it. But there are realities out there in many countries where the auto-enrollment was introduced step by step and created this trust and created also this way to have better coverage on the pensions area. Secondly, I think we need to have enough courage, I would say on a European basis, to go from what I call a policy of removing obstacles on the pension side to have a policy of being the catalyst for change. And this is something that we have done with the PEP on the personal pension side, but I believe that this needs also to be done on the occupational pension side. And that was my strong push along these years, to focus on the CMU more on the demand side, to focus on the occupational pensions, to have a structured approach to retirement savings on the occupational side. I couldn't agree more with what Guillaume said. It's on the occupational side that a lot of engagement can come also to have better outcomes for pensions in the future. And for this, I would say that we need two main things. We need good pensions by design, and we should not stop, short of confronting the key issues that have delivered poor pensions in the past. And this is also about design. It's about being more standardized to benefit from economies of scale. It's about having default bases. It's about really design to avoid this loss aversion in terms of short term. And I think that we have proved that with the PEP that can be done in a sound way. It's about also having more transparency to make sure that we benefit from the digital age to deliver better information, engaging information, as Sheila was mentioning. I couldn't agree more, but also to use digitalization to bring costs down in terms of the advice and the distribution. So cost effectiveness and cost efficiency is fundamental. So this is what I call good pensions by design, and we need to deal with this. And then I think also we need to move ahead towards pan-European frameworks like the PEP, but also on the occupational side. There's no reason why we cannot build a good basis for having pan-European occupational pensions. I've put out these ideas some 3 years ago. I didn't have so much support, to be very honest, because of this idea that, in some countries, Europe wants to get our pensions. Sorry, that's nothing like that. We need to build good standards of pan-European occupational pensions, because we're not benefiting from the internal market right now. And we can, and this is not only about multinationals, which actually have supported this initiative. It's also about many, middle stand companies in Europe that have offices and factories throughout Europe that cannot right now basically have the most efficient way of dealing with pensions. So this, I think, is possible, but of course it needs a lot of political willingness. But to be honest, we have a window of opportunity right now. With this post-COVID environment, where we will need to have a recovery based on growth, but also a recovery that I hope that still continues to protect people and to have market stability as a fundamental element. We have the Green Deal and all the agenda of sustainability. We have the digital transformation that can help lowering down costs. So all of these, I think, are catalysts. So there's a huge opportunity, and there's this window of opportunity is there, and we cannot let this be passing away without us really getting tangible results. And tangible results like the PEP. And many people ask me, is the PEP a silver bullet? And I always respond, no. PEP is not a silver bullet, but it can be really one of these transformational, one of these paradigm shifts. And I'm really proud of the work that we all together made, because this was not a work done by supervisors alone. This was work done, with industry, with consumers, with a lot of representatives across the board. I think that now it's up to providers, insurers, asset managers, competition is there, pension funds, to really deliver these products. It's up to governments also to really give the appropriate tax treatment. But at the end of the day, it's also up to consumers. Consumers need to be more aware, and I'm very happy that consumer associations throughout Europe are embracing the PEP. And believe me, as I said, this can be transformational. This can be really a huge part of changing this equity culture. The way that we build up the PEP, the risk mitigation techniques, it's really to have more and more long-term type of equity exposures. This is the catalyst that we need. What we need right now is that consumers also ask for it, because at the end we know it. Supply will always follow demand.
Thank you, Gabriel. Very clear, especially concerning the political courage that needs to be present at member states level concerning a possible restructuring of their pension policies, certainly when it comes to the second pillar. Tanya, I will ask you in a moment to let us know about action number 9 of the Stimulus Action Plan. But before I do so, I would like to ask Thomas, Guillaume, and Sheila to react to what we heard from Gabriel. Thomas.
Well, I think that I already said this in terms of engagement of investors and savers. There's nothing better than personal pensions, and we welcome the PEP. We think that was a great success. It's where there are some caveats, of course, like the fee side. You are not surprised. But altogether, I think that's the right step forward. I fully agree with what has been said by Gabriel. We need to mobilize capital into European pension funds. We need to engage people. That's the best way to make them more interested in their own situation, pension situation, and so on.
Thank you, Thomas. Sheila, and then Guillaume, briefly.
Very difficult to disagree with anything that's been said. I suppose the one comment I would make, and I fully understand that the whole issue around auto-enrollment is a heavily political one, but the UK experience has been extraordinarily good. Opt-out rates on auto-enrollment have been huge, tiny in the UK, even as the levels of contributions have increased. So, that would be all I would say about in response to that at this stage.
Thank you, Sheila. Guillaume?
Yes, as Gabriel knows, I have a lot of sympathy in general for his positions, which I support generally. In terms of personal pensions, it's more of a challenge. We do need definitely a pan-European personal pension product and standard, and we have it, and it was not easy to get to that. It's not perfect. Where I slightly disagree with Gabriel is that, unfortunately, the PEP and this kind of pension products, they are still quite technical and complex, and they are more sold than bought for this reason. And I wish, of course, a lot of success to PEP. I wish also member states to do the job in terms of taxation, but also I wish in a future review, because I'm always a dreamer, that we can simplify the PEP. That will be key for getting people to really engage more into this product. Thank you.
Thank you, Guillaume. Let me get back to you, Tanya. So as I said, action number 9 of the Stimulus Action Plan foresees a number of initiatives related to pensions. Can you tell us a bit more about them? And do you think this is ambitious enough?
Yes, that's the question. No, maybe before I'll get into the actions themselves, I'll just comment very briefly on what has been said by Gabriel and Guillaume and Sheila and Thomas, and I'm very happy to hear and to see that there is actually wide agreement on the importance of occupational pensions. I mean, personal pensions, obviously, and there has been a lot already done in this area, but occupational pensions. And I think this part of the pension universe has been neglected so far. And I think the window of opportunity is also coming from the fact that we will have national budgets under an extreme strain as a result of all this public support that is now pouring into companies. So Pillar 1 is going to be very difficult to sustain going forward, and we're talking about the active workforce that is going to contract even further, and pensioners grow with years to come. So we need to make sure that we have supplementary options, that we have that we offer to citizens, ways to supplement Pillar 1 or statutory pensions. And it can be Pillar 2, so it can be occupational, it can be Pillar 3. So I think I'm very happy to see that we all agree on this one. On what we've proposed in the Senior Action Plan. So to summarize, these are measures that are going to fight or try to address the lack of awareness or the information dimension, and that lack of awareness is coming both at the side of individuals. So that's why we want to work together with Gabriel's help, hopefully, on best practices on developing national tracking systems. So what it means in reality is basically comprehensive pension statements for citizens, for them to know actually how much they're saving for their retirement age. Because in many cases, we have people being completely oblivious to how much money they actually are keeping for their older age. They don't realize. They think they have enough because they have a salary today, and they will have enough because the state will care for them. But in reality, many of them don't realize that they will not be able to sustain the existing lifestyle that they're currently enjoying when they reach their retirement age. And I think this pension statement, which sounds a bit technical, but in reality is nothing more than, basically, a piece of paper, hopefully digital piece of paper, which is a contradiction in terms, but let's say information that is being given to each citizen that would tell exactly how much this person would receive monthly in terms of its cumulative pension income. And there we need to have a comprehensive view. So it's not just state-run pensions, it's also occupational pensions, it's also personal pension products and long-term investment products that can be seen as supplements or complements of personal pension products. So it's important to give this overall picture view to the citizen, because it can be a massive driver for behavioral change. If you realize that you couldn't be making only a few hundred euros or even 1,000 euro when you're going to be 65, it might lead you to believe that you need to start considering where to invest. And this is what we want to support. So this is the first action. The second action is about raising awareness among member states. about the lack of, let's say, pension adequacy and sustainability in some cases, but sustainability deals with more the capacity of their budgets to sustain Pillar 1 pensions. But adequacy is important, and I think in some cases there is lack of understanding also on the side of the member states themselves, that they simply, have a large portion of their population not covered by any pension income, very little pension income. We have the data that suggests that about 18% of EU citizens are going to be on the bridge of, of poverty rate. 18% of EU citizens. It's a huge number. And I think member states sometimes do not realize that they're facing an incredible challenge. And with all the, things à la mode, like green and digital and, and all other things that matter. And COVID, of course, it brings with it new important things and emergencies to deal with. And the demographic challenges sometimes are just being forgotten about. They've been with us for so long that they're no longer considered to be as urgent, as important to deal with. But it's wrong, because ultimately it will be important, and I think we will pay the price for not taking it seriously, and the member states will pay this price. So in order to raise the awareness of the member states, we are going to develop some sort of dashboard with a comprehensive view of pension adequacy across the 3 pillars at the aggregated level of the member states. And this is the tool that will allow us to also see where different member states stand. It's also a tool that would probably trigger some action from the member states side when they see how they compare to their peers, because we shouldn't underestimate the success or the effectiveness of peer pressure. And the third element is the element of engagement. And Gabriel has spoken about this, and Thomas spoke about this. So auto-enrollment, it's a complicated issue, it's a sensitive issue, it's a political issue. But I think there are things that we can do. And, what we are proposing now is within our remit. So working on best practices, building on what has already been successfully implemented in a number of member states. Okay, Sheila mentioned the UK. Thomas mentioned the US. Okay, these are no longer, or at least the UK is no longer the EU member state, but these are all very helpful and useful, I think, experiences and cases which we can build on, and where we can spread this knowledge across member states. And so when they realize how little pension adequacy or coverage they have, based on the dashboards, they will have a tool to actually address this by using the best practices that, again, with the help of wider community, and at one point also Gabriel's help, we will hopefully put in place and supplement the efforts of the member states in this area. Thank you.
Thank you, Tanya. We need to move on, but Gabriel, very briefly. Yes. I guess I'm very supportive of those, measures foreseen in Action 9 of the CMU Action Plan. But were you somehow disappointed by the perceived lack of ambition of the CMU Action Plan when it comes to pensions, or it's all okay?
Well, everything that is in there is good. That's clear. What Tanya mentioned, the pensions dashboard, the pension tracking systems, the study on auto-enrollment, clearly it's very important and very good steps. But the issue is that I think we cannot stop here. We need to have already the clear vision in terms of what should be the next step. And for me, the next step, as I mentioned before, needs to be based on making this a political priority, not just being based on the CMU. I think really one of the things that I found very good all this is that we changed the narrative. Instead of saying that we need pensions to support the CMU, now we're saying we need the CMU to support pensions adequacy. That's the right narrative. And we know that this is very often ideological, also from a political perspective. But so I think we need to go mainstream, as I said. And the second point, the next step, and on using all these tools of the pension dashboard, the pension tracking system, we need to integrate this discussion of pensions adequacy into the economic governance in Europe, into the European semester. Then the Commission can then, of states will need, based on the evidence, will need to make reforms. And then the Commission and the EU as a whole can be more than punitive, can be conducive, can be supportive. And don't underestimate that. I think that's very important. You know, for example, in our work at EIOPA right now, we are engaged with two member states, and I will not say the names because this is just discussions that we have been having at ministry level, that are very interested on implementing supplementary pension second pillar in their countries. And they want to have good practices. They want to build, and we are using, you know, the DG reform funds also to do that. So that's the right approach. Europe can be, on the one side, challenging member states to do reforms, but on the other side also be supportive and use the funds and use also you know, the money that will exist from the recovery to make sure that member states will go in the right direction. These, I think, are the fundamental things going forward.
Thank you, Gabriel. I have one more question concerning the role of taxation to encourage long-term investment. I mean, how important is taxation in all of that? Anyone?
May I respond to what to the information piece delivered by Tanya? There's something going on in Denmark. The Danish already have such an information system, and it's been introduced in Germany because most investors have no clue of their pension income. So the effort is to compile all kind of information from life insurances, savings plans, fund investments, first pillar, second pillar, third pillar, and all together. It's a hell of an exercise because all these formats are different. It's difficult to compare. It's difficult to compile. I have much understanding for the slow progress that the project makes, but it's anyway, it's important. It's on the way, and I think that is really important. As for taxation, the role of taxation, Tanguy, I think the role of states is paramount in our business. At the end of the day, the entire investment industry, from life insurances, asset managers, banks, mortgage companies, building societies, everybody who is offering investment products, at the end of the day, it all comes down to three assets that are creating values. We all invest in the same. We invest in corporations, we invest in states, we invest in real estate. And the financial, the value that we bring is access for investors to all these assets, and the wrapper, the best wrapper for a specific client, be it retail client, an insurance client, a corporation client, the state as a client, communities, and so on and so forth. From a risk perspective, from a taxation perspective, they all have different needs. And that is our core value that we bring in. Provide the perfect wrapper and provide access to all these different asset classes. So if we talk about the wrapper, of course, is heavily influenced by regulation. And the success of a wrapper really depends on regulation, and in particular taxation. I can give you a couple of examples. Look at the 401k IRA thing. I mean, that has been introduced end of the 70s, beginning of the 80s, and look at where the investment industry in the United States is today. It's so successful that they have a market share of a global market share of almost 50%, and that is due to regulation. Look at life insurances in Germany. There are 83 million inhabitants in Germany, but 91 million life insurance contracts, which means there's much more life insurances than lives in this country. And why is that? It's an investment product that has been heavily subsidized by the government. It was tax-free until 2004. Look at the money market fund business in France. It is so far bigger than in any other country. And why is that? For historical reasons. So there has been developed a certain infrastructure, a certain money market fund culture, as there was more or less a ban on interest rates on accounts, on giro accounts. So it has the impact of regulation is just huge in our industry. It cannot be overestimated.
Thank you, Thomas. We are running a bit behind. So I have one question to you, Sheila, and then I would like to move on to the second part. So the question to you, Sheila, is the following. Do you see any potential for ESG finance to attract a new breed of investors, especially retail investors? Is there any potential there? And do you see any evidence of that on the ground? Sheila.
Thank you, Tanguy. Interestingly enough, I actually think we're getting pretty close to the stage where if we don't, we won't attract investment unless we offer sustainable products. So I don't think it's an add-on. I think it's getting very close to the point of being a sine qua non. And again, you know, in that same survey that I talked about, 77% of respondents said that they wouldn't invest outside their personal beliefs. So yes, the regulators and legislators are doing a lot in this direction, but the market is moving extraordinarily fast on this one. At Schroders, we decided that by the end of 2020, we would have sustainability integrated into all our funds. And we thought that that was going to really be a differentiator against the rest of the market. Now we're having to take the next stage as to what is the next differentiator in terms of sustainability. So regardless of what, you know, combined with the regulatory environment, the market is actually dictating that. So we are not, and we do need to talk about, I noticed in the last panel, there was a question about the average age of investors. I think we also need to attract a younger investor group. We are not going to do that unless we offer ESG products. And actually, sorry, I should have said in that 70% of respondents, actually it was Singapore and US brought the averages down. Those figures were even higher in Europe. So
the numbers couldn't be clearer. In 2019, 40% of all inflows were attracted by sustainable funds in the retail business, 40%. Until end of September 2020, it's more than a third. In the first quarter of 2020, including this the Corona crisis in March, we had inflows of 3 billion euro in retail funds, while we had at the same time 17 billion outflows in regular funds. So even in this first quarter, sustainable funds were able to attract new money. Provided they are genuinely sustainable, and that's of course being tackled.
That's the big risk.
Yeah, sure.
Let's now move on and look at ways to improve the investors' overall experience. And I think talking about disclosure seems a very natural starting point. So Guillaume, what is your take on all these disclosure requirements? Does it really empower consumers? Is it time for a complete rethink of what to disclose to consumers and how? And then I would like to hear from Thomas. Guillaume.
Yes, I hear very often that, you know, disclosures have no impact, no importance, that nobody reads them, blah, blah, blah. I don't think it's a reason to do a bad job with those. First, where, yes, we need really not only a rethink, but an entire redesign is on the format. We just talked about the younger generation for sustainable finance, but what the younger generation need and want, it's something that is readable on a smartphone. And also on a smartphone, they are used to compare products with one another. So this is not possible currently with the key information documents that we have. So the format has to be thoroughly redesigned. And for example, we will benefit from technology because, for example, some details can be put in drawdown menus. So it will be much more customer friendly, user friendly, and maybe then people will look more at it. One other reason why two other reasons why they don't read it is sometimes it's too long. So that's why there were these very good initiatives in European law since 2010 with the UCITS fund key information, investor information document, and nowadays with a lot of key information documents for PRIPS, for PEP, etc. So that's shorter, but the other key condition is that it is clear. It is in the law, by the way, it is in the EU law, it has to be clear, fair, and not misleading. This is the least enforced provision I have ever seen on investor protection, because most of it is still not intelligible. Even myself, I'm trying to read those for too many years now, decades. Sometimes I am really scratching my head. So yes, people have a low literacy, financial literacy level. Yes, then you should take this into account when you draft your key information. Also, you have to be very careful, and I will stop there, Tanguy, but because I could go on for a long time on disclosure, you have to look at what behavioral finance can bring. And so don't use cognitive biases against us, but for us. And I give you two examples. One is monetary illusion. So we are never, even for long-term investments, we are never shown real evolution, for example, of performance. Only OECD and Better Finance do it, to my knowledge, for example, on pensions, on pension funds. And also, it would help for the capital market union, because if you show, for example, over the long term, what money market funds, I think Thomas was talking about money market funds, what they deliver, then people will start to think, maybe that is not the best instrument for my pension savings. Because yes, in France, for a long time, it's been the default option, believe it or not, for pension saving. Also, loss aversion is the same thing. If you show to people the time horizon, and again, if you compare, over for pension products, and that's the main reason why people save for the long term, and that's why I'm referring to pensions. And as we said, it's really a critical issue. They will see that a diversified portfolio or funds of equities, will not only be much more performing, but which will have a lower risk of losing your pension money. Last thing, we really have to keep to intelligibility and common sense. I give you just one example where I see the EU authorities very far away from common sense nowadays. It's on the infamous PRIPS debate. I read what the European Parliament said on PRIPS. I read to you, I love this. I mean, I love this, it's ironic. It is very important to ensure that both past performance information is available to investors, and that past performance cannot be used as an indicator to predict future returns. I could not agree more with that. The next position of the Parliament is, let's kill the UCITS ID, which is providing past performance information, is not using past performance as to predict future return. And let's keep the PRIPS kit, which does exactly that. It will not disclose to us the actual performance, and it is using past performance to predict future return. So let's go back to common sense, please. Thank you.
Thank you, Guillaume. I would like, before asking Tanya and Gabriel a question about PRIPS, I would like a short reaction from Thomas, and then we move on. Thomas.
I think the disclosure thing, I wouldn't say we got it all wrong, but a lot went wrong on the disclosure side. So normally, or as a matter of principle, one can say it's too much, it's too long, it's unwanted. Sometimes it's inconsistent. Look at the cost disclosure in MiFID and in PRIPS. There is a lot of room for improvement. It must be shorter. It must be reduced to the really essential information, and it must be comparable. Comparability is actually the key. But believing that the more information the investor gets, the better it is protected, he is protected, that's delusional. it really must be reduced to what is really essential. And then it is biased. It is risk biased. We were just talking about risk-averse investors, but look at what we have to disclose. It's all about risk. Some of these financial products are considered as toxic, with warnings. Please don't buy. It's extremely dangerous. There might be illiquid stuff in it, etc., etc. If we continue to treat these products as we are forced to do now, the capital markets union will not progress. It will not progress. It's not toxic. So I also think that the way we have to communicate risk must be reformed. That's definitely wrong what has happened in this field.
Tanguy, can I just make one suggestion? That we stop using the words disclosure and transparency and we start talking about effective communication. Because disclosure and transparency comes from us to the investor. Actually, what we should be doing is having effective communication. And that mindset that we've got at the moment, because of the language we use, I think is all wrong.
Yeah.
That's maybe something for the retail investor strategy that the Commission will put out in the first quarter of 2022. Tanya, Gabriel, a good conference is a conference where there is a scoop. So I was very much relying on one of you to give us a scoop about the future of the UCITS kit. And we have this UCITS exemption running until the end of 2021. So will you guys save the UCITS kit, or will you allow the PRIPS kit to damage the UCITS kit comes January the 1st, 2022? I guess this is more for Tanya than for Gabriel, but of course, Gabriel, you have been extremely involved at level 2. So maybe Tanya, and it's true.
Thank you, Tanguy, for an easy question. Unsurprisingly, there will be no scope. So I can tell you exactly what we're doing now. I mean, I think for the majority of, I guess, participants, it's a known fact. So there was a solution in the cards. This solution was, an RTS, level 2 measure, secondary legislation that the 3 ESAs would agree on, and that would allow to fix what was broken in PRIPS kit. And we all agree that it didn't quite work out the way we wanted it to work out. And there were certain issues, and that would be the solution. And then, unfortunately, we had a hiccup with Gabriel's board of supervisors, who decided that they wouldn't sign up to this secondary measure, which made our life complicated in the sense that could be that there was supposed to be the right solution. There was supposed to fix the problem, and would if the solution works and would have worked at the time, it would have solved also the UCITS issue. Because I think if PRIPS kit is fixed, then I think no one has anything to fear about the exemption lapsing for UCITS kit. So I think from the side of the Commission, we still believe that a solution is possible, that a secondary legislation or fixed through a secondary legislative measure is still possible. We're working together with the ESAs to sort it out, and provided we're successful, there is no need to save UCITS kit. So I think that's kit, whatever kit. I think it's as easy as that. Now, if this solution doesn't work out, and I don't have a crystal ball to tell you, whether it will be or whether it won't work out. But I can tell you that, the Commission and Gabriel, I'm sure, as well as Stephen, will do everything, in our powers to make sure that it works out. But if it doesn't, then we can think about, what we have to do then. And yes, there is an issue with UCITS kit, but I think this is not the question to be answered now. If we are still committed to finding a solution for PRIPS kit, we should rather focus our efforts on finding a solution for PRIPS kit. And I'm stopping there, and I'm sure Gabriel will have much more to say.
Gabriel, very shortly, please.
No, if I can very shortly, just to say what happened. Of course, my position was very clear. I believe that what we proposed was a good progress. It solved some issues related to the performance scenarios. It clearly I'm a believer in, giving past performance. I've said this. That's, as Guillaume said, that's not the view politically. Then, and of course we need to deal with that. Unfortunately, we got the simple majority at my board, but not the qualified majority, because a number of member states, a number of authorities thought that they prefer to have a level 1 change sooner than later, and they don't believe that the best way would be to go and to do this kind of interim change. So that's the situation in which we are. I hope that that this can be, of course, overcome. But if I may, just 2 minutes on what was said in relation to disclosure, because I think we have an opportunity in here, and also to the PRIPS file, to be very honest, because I also believe that we can do better. And a number of the points that what Guillaume mentioned in relation to disclosure, I think the good thing is that we were taking steps. If you look at the PEP, we have a number of elements already in the PEP in terms of, having layering information, not to flood all the information in one document, to have this format to the smartphone using the digital element, and to have engagement, to have icons, to have questions to the people. I think it's much more easier. Also, the loss aversion element, to have elements that we have now in the PEP, which are focusing on the risk to the retirement objective and not the risk in the assets that you have, which is a completely different way to look at the information that to give to the consumers. So I think there are good things there. There are good examples in the PEP. I think that we should use these to really make a paradigm shift in terms of disclosure overall. And I think that there's something which needs to be changed, to be very honest, because I think there's nowadays, and in the PRIPS file, it's very clear, there's a mix between two things. One thing should be information to be given to the markets, to the distributors, to the supervisors. Another thing, it's information to consumers. And if we mix those things, and I think that PRIPS is a real case of mixing these two things, we will never succeed. And I think that both are important, but we need to do them separately. Otherwise, we will have a lot of issues. And please understand that the issues are not only on insurance, to be very honest. The issues are also on the asset management side with the prospectus. That is something that no one reads, no one understands, everybody signs, but there's no added value for a consumer. That is information for the distributors, for the markets, and for the supervisors. A normal consumer, a normal man in the street, doesn't understand anything that is in there, and it's just a way to alleviate liability. Sorry, I need to say this.
Thank you, Gabriel. I think just to finish on PRIPS and UCITS, at EFAMA, we feel that unless a solution is found for the PRIPS kit in the coming weeks, really, we would expect the Commission to come out with a proposal to prolong the UCITS exemption, because it cannot wait until until February, March, or April next year to find out what will happen with the UCITS kit. Anyway, let's move on now to the notion of value. Sheila, you mentioned to me recently that this is more than just about value for money. So can you please elaborate, and can you tell us also about your experience with the recently introduced value statement in the UK? And then I would like Guillaume and Thomas to react.
Yeah, thank you very much, Tanguy. Yes, I mean, it's worth remembering that the value statements that we've been making recently started off with the FCA's review of asset management generally, and the conclusion that investors were not sufficient power in looking after their own interests, and that we needed to have stand in their place to help them, their interests be considered. They started talking about value for money, but actually they stopped and they changed as a result of consultation. Actually, they changed the phrase to value assessment. And that was basically because they recognized that costs are not the be all and end all. And that actually costs need to be looked at alongside quality of service, alongside performance, alongside we need to take account of economies of scale, comparable market rates, classes of units, and so on and so forth. So it's not just about costs and cash. I think the other important thing in this is to recognize that it's actually not just, again, it's not just about costs, it's really actually about governance. And actually, alongside the value assessments, or behind the value assessments, were requirements to have independent directors on AMC boards. And that with a particular focus on the investor and challenging the executive. And actually, if anything, that's got a much wider implications, because of course, these independent directors are not just looking at costs. They're directors of the company, they've got other responsibilities as well, and other particular focus on the investor. So it needs to be seen in a wider context. Generally, I would suggest that actually it's been a positive experience for Schroders, particularly, and I think across the board generally. It has forced us to be pretty systematic in focusing on all our funds. And it's perhaps shown, Guillaume might try and say, well, why did the regulators have to force you into this? Shouldn't you be doing it already? Guillaume and Bernardino and Gabriel might be saying that. But actually, I think what it did, it's required us to be systematic and to look in all the dark corners. And bring out all our junk. And it's also been a very important exercise in communicating with investors. We actually put a lot of effort into how we were going to present the value assessment. Two lessons, I think, broad lessons to be learned about this are the FCA and indeed the trade associations did not tell us how to do this. There was quite a lot of pressure on them to offer templates, to say how we did, what this value assessment needed to do, what we needed to think about. And they actually deliberately held back from doing that. And by doing that, they actually forced us to think very hard for ourselves rather than just tick a box. So I think that's an important broad lesson to be learned in terms of regulation. And I think the other important message that we've learned is actually about the power of public commentary. Now that we're producing these documents, it's not, retail investors saying the Schroders version is better than the M&G version is better than the Fidelity version, but it's actually the informed press, the trade press and so on, saying, well, actually, this was rather good. And the way you did this was actually quite good. This was complete rubbish. And that, I think, is going to improve the quality of this. So I know there are those who are saying, oh, is this going to be extended beyond the UK elsewhere? I think I mentioned the governance because that was specific to the UK. But I would broadly say there isn't an enormous amount to fear from this. And I think, it's much better than, for example, applying pricing caps, for example. So, and I see Gabriel wants to come in now.
Gabriel.
No, I just wanted to react because I think this is one of the most important discussions that we need to have. And actually, at EIOPA, we have been working on this already, for more than 1 year, specifically on the unit-linked side and on the application of, product oversight and governance requirements and how supervisors should approach it. And actually, it's interesting that, just a couple of weeks ago, we published a document just saying what is our supervisory expectation in relation to the application of these product oversight and governance requirements. And it goes completely in line with what Sheila was describing. So we are very clear, we expect companies within their product oversight and governance requirements to have very clearly included what we call it a fairness value test that needs to look at the product, all these components, and to have an assessment by the company and by the board before the product goes out, and then to have it, of course, on a continuing basis during the life of the product. And supervisors need to act on this. And that's why, I think when we talk about things like disclosure, etc., disclosure is not a panacea. We will not solve all the issues with disclosure. I think it's very important to look at really the issues related to the implementation of this product oversight and governance, and also on the intervention powers by supervisors. I can tell you, we had already an intervention in one concrete case of a company of a unit-linked product that was being sold throughout Europe. And based on our assessment, we arrived at the conclusion that, the value of that product was quasi inexistent, to be very honest, on top of many other things. And we clearly had a product intervention. We communicated this to the company, and the company decided to take it out from the market. So you should expect more of this happening from the supervisors. And this is, I think, the right way to go. And it's nice that Sheila mentioned the point that it should not be supervisors defining the format and defining what is the assessment. That's the approach that we're taking also. But let me say a final word. We need to be successful on this one, because if we're not successful, and so if the industry is not responsive to this, the outcome will be for sure to have caps and to have definitions in terms of costs, and then it will be blind in relation to cost and risk, cost and returns, and that I don't think it's the good approach at the end of the day. We need to get it right, but this is the right way to go.
Thank you, Gabriel. Let's go to Thomas, and then I will let Guillaume have the final word on that. Thomas.
Well, I've got nothing to say about that one. I'm happy to hear from Gabriel that he's against any caps. That's good news. And so far, I can say that the value concept is, I would have to have a deeper look into what's going on in the UK and so far. But if it's widening the focus and going a little bit away from the cost fixation, it's a good step forward, because advice and the product and what is done within the product is just more than this. It's not. There's more than costs, and informing investors about this, I think this is a core task of our industry.
Thank you, Thomas. Guillaume, at last.
Yes, we like very much this approach of value for money. Indeed, one of our last conferences was on sustainable value for money. So to link the long-term value for money, the pension adequacy with the sustainability issue. And cost is not, of course, the only factor to get value for money. However, I just wish to refer you to an excellent independent study on all retail equity funds in Luxembourg, France, and Belgium over 10 years and more. And there is a reverse correlation over 5-10 years between performance and costs. When you increase charges by 1%, you reduce the excess return by 0.45%. We did multiple regression on several, expert academics, but we commissioned the study, multiple regressions on other factors, and cost comes as the most important. It's not the only one, but it is the most important.
Thank you, Guillaume. Turning now to distribution and advice. Thomas, we hear some people saying that distribution channels in many European countries are antiquated and prone to conflicts of interest. What's your perspective on that?
Well, whatever antiquated means, there is one very, very modern, state-of-the-art way to sell funds, and these are the robo-advisors. However, the robo-advisors, even though existing since several years, are not a big success. According to a survey that has been conducted by an agency in beginning of 2020, the total assets under management of funds being sold via robo-advisors amount to 8 billion euro in Germany. 8 billion euro. This is less than 1% of the total assets under management in retail funds in this market. And you may say, well, might be German figures. It might look different across the EU. It does not. The German figures amount for 60% of the total robo business in the EU. There's only the UK that is more advanced. Total assets in the UK of funds being sold via robo advisors amount to, I guess it was 13 billion. So it's a bigger figure in the UK, but one can say that after several years of existence, robo-advisors do not thrive. That's pretty obvious. So that's why most people need advice. In Germany, we estimate the number of self-directed investors between 5 and 10%, which means that about 90% of the investors rely on advice, and then they need advice. So, and now we come to the conflicts of interest about being prone to certain products that include higher fees and kickbacks than others. That is obvious. We have to find ways to handle this, but the way to handle this cannot be a total ban on inducements. That is not successful either. Maybe Sheila may comment on this, but it is not successful. By doing nothing over the last 10 years would have been one of the worst investment decisions ever. Even the most expensive equity fund would have been a much better choice than doing nothing. So leaving this advice gap cannot be the solution either. And then we sometimes focus on bans in MiFID and so on. And so I'm happy that Gabriel is here. Any discussion on a ban on inducements cannot exclude life insurances or other savings products. So if we talk about that, we would have to have a level playing field. So it is not sufficient that ESMA is developing ideas about inducements in their field of responsibility. So that must be, if ever, a wider discussion. And finally, Guillaume was referring to the number of ETFs being sold in the US and in Europe. In Germany, the market share of ETFs in the retail business amounts to 20%, and it's ever growing. So I think, Guillaume, we are talking about the timing. You are too impatient. You can't wait. You want the government to help you.
Indeed.
You want legal power. You want legal force. That never existed in the US. There is no law in the United States.
I don't want legal force, but I will give my opinion.
Show me the law. Show me the law in the US saying that the inducements are banned. Show me.
I will show you a law proposal that you will like. The one in the HLF-CMU report.
We are talking.
Your colleagues supported it.
We are talking about the timing. You can't wait. What you want is a disruptive evolution or in the advice space. Even though the market, even though the market is actually doing what you expect him to do, and that's why I think we better stay on the way we went for the past 10 and 20 years.
Thank you, Thomas. Thank you for making this discussion lively. Tanya, you wanted to react on robo-advice.
Yes, indeed. I was listening with great interest to what Thomas was saying, but I was wondering whether the lack of uptake, let's say, of the robo-advice is not directly correlated to the lack of education and to the lack of the use of technology by the by the big bulk of potential investors, because I'm sure, you know, if we look into the data and we check who is actually using robo-advice potentially, you will see more younger people using it, and older people probably staying away from digital means. And I think there's a good explanation to that. So I think by fixing some of the issues that we are having, such as more distribution by digital means, I think also the comparability and digitalization of disclosure documents, because this is essential, I think, to ensure comparability also through digital means, might have an impact also on robo-advice. And by the way, when I was discussing robo-advice with some market participants, they were raising the issues such as uncertainty about whether or not algorithms behind those robo-advice actually are compatible with the rules. And because because of them fearing that it wouldn't be compatible, and because of the liability that it would open them up to, there is not as much take-up of robo-advice as you would otherwise see. So I wouldn't be too quick arriving at conclusions that digital distribution and distribution, on the basis of a robo-advice is necessarily bad, or is not picking up in Europe. So let's just be cautious on this point.
But Tanya, after 1 decade of existence, I think one is not quick in doing a first assessment the success of these robo-advisors. The reason why it's not a bigger success is definitely, as you say, it's education. Yeah.
But as you said, everything is slow in Europe.
It's education. It's more education than technology, actually.
Yeah, thank you for that. I would like to hear from Gabriel, because I know that you have some views on advice, and then I will ask Sheila briefly to report on the UK experience on inducement, and then Guillaume, I will really want you to express your views and take the time to do so, because of course, we
be happy to do that.
So maybe first, Gabriel, on advice.
I think that we need to confront the reality, and the reality is that its distribution costs are too high. Let's be honest, and this was, if you look, for example, at savings products, you've seen that in the past already, but since 10 years that we are in this low interest rate environment, this is now much more a huge reality. A good part of the extra return that you could get with products on the long term is taken up by the cost. So distribution costs, I think, are too high, and we need to confront it. I think we need to do more in terms of using digital, but also I think we need to have also more simplified products, because if we have more simpler products, I think it will be easier also to sell them to digital. And from a regulatory perspective, I believe that we should also make an effort to have requirements which are more proportionate for simple products in terms of distribution. For example, requirements on suitability. I think if the product is really more simpler, I think that we could also have an effort to reduce those requirements on products that are sold from a digital perspective to bring costs down. On advice, advice is needed. That's clear for different types of products. I've got a position in here that is focused on the objective. The objective, I think, should be to have good engagement from consumers in the products that they need, and to have advice for the products that they need. And we should be, especially concerned with the low income, consumers, because of course, the high earners, they can pay for the fees for an advice. There's not a point. There's not a question. But for the low income people, I would say that they will not buy advice, a standalone advice. So we need to find a way to have this advice to be given, to come down, to have costs of distribution down, but that people can continue to have access probably to more simple products towards digital means.
But that's interesting, Gabriel, that you are talking about simple products. I mean, what makes products really complicated, for instance, are guarantees or capital protection mechanisms. That's actually making products really, really complicated.
Yeah, but we need to have choice. If a consumer wants to have a guarantee, of course, you need to have those products there. And I agree with you, the products are more complex, but that's the reality,
Well, a bank saving account is very simple, and it has a
life insurances and things like this. That's the really complicated stuff.
Yeah, but it has an extra value for consumers also. So that's the point.
So Sheila, on the UK concerning inducement, and then I will hand over to Guillaume to hear from Better Funds and their views on all of that. Sheila, on the pan-Indeed inducement, what has been your experience so far in the UK?
Probably first important disclosure for those who don't know, I led much of the retail distribution review when I was at the FSA. So just to warn everyone about that one. But actually, I haven't advocated an inducement ban throughout the whole of Europe, largely because I would disagree that it's been a failure in the UK. I think it has been successful in the UK. But that the structure of distribution is very, very different in the UK. Generally, the person who is offering the advice and the person who is negotiating with the product providers generally have a much, much closer relationship in the UK than they do in continental Europe. So most of the advisors are much smaller businesses. An advisor in a Santander advisor in Bilbao is very far away from whoever is negotiating with Schroders about distributing Schroders funds around Spain. So actually what really matters is the incentives that are on advisors and salespeople. And we've already got powers around that. There are already rules in MiFID around incentives on advisors and salespeople. So I think that's where we need to be focusing, not specifically on inducements. I would also say the other difference between the UK and the rest of Europe is that there is far, far more third-party distribution in the UK. And I don't see how you apply an inducements ban when you are when you've got in-house products. So we need to think very carefully about what the implications of an inducements ban would be in terms of actually pushing businesses towards more in-house products, which are generally not the ones that are considered to offer value for money. So I think that that's a very matter of concern. And the only final point I would make is that the RDR wasn't just about banning inducements. The RDR was actually almost more importantly about professionalizing the advice market and the professionalizing advisors and introducing higher minimum qualification requirements for advisors. And we mustn't forget that that is also among the recommendations that we've introduced for CMU. I know Tanya has challenged us on this, saying that is not a competence of the EU and the Commission, but in all sorts of other spaces, we're finding ways of nudging and encouraging and persuading member states to do things. So I would also, I think it's welcome that because, just by way of final point, coming back to this point about simple products, we are a very, very, very long way off Europeans waking up in the morning and thinking, oh, I should buy a fund today. Oh, I'll open up a KID on my smartphone and or a comparison table and put some money into a fund today. They want their hands held. They want advice. And therefore the quality of the advice that they're offered, not just investment advice, but holistic financial planning about seeing the investment as part of a much broader consideration of their overall financial position, I think is the direction that we've got to go in.
Thank you, Sheila. Guillaume, you have been very patient. So you have the last word on distribution and advice, please.
Yes, I have been very patient, although I agree with Thomas, I'm kind of impatient as a person. Where I do not agree is first, you know, you are all talking about inducements. First, let me tell you that retail investors have no clue what means this strange word. If you talk about commissions or like Gabriel one day about kickbacks, then they better understand. Second, we talked about the robo-advice. We've been researching robo-advice every year now, and we will publish our 2020 report next month. And yes, it's true that the main factor for the little success, this I fully agree with Thomas, what you call it education. As I said, there is no such thing as adult investor education. They don't go back to school. It's because, you know, when you go on the first page of a robo-advisor, you are already totally lost because they tell you first, we have no inducements or commissions. 99% of people have no clue what they mean about that. And second, we base our offer usually on ETFs. They have no clue at all what you are talking about. Why do they have no clue? Of course, it's not taught at school, but more importantly, it's not talked about at the retail point of sale. So they don't know. So that's one key reason for the lack of picking up of robo-advice. Now on the proposals. So Thomas, I am not for a disruptive measure. By the way, you just heard Sheila that told you it was not disruptive in the UK, it was not disruptive in the Netherlands. But in addition, I am not even pleading for this. I have been pleading, in fact, with Sheila and others at the HLF CMU to do two things. First, to make the rules on commissions consistent between the MiFID products and the other products, especially the investment-based insurance products. And I think I heard you agreed with that, Thomas, so that also on EBIP's portfolio management and on EBIP's independent advice, which, by the way, are two terms that do not even exist in EU law for now for insurance-based investment product, that should be banned as well, because, for example, in France, investment funds are more subscribed via unit-linked insurance contracts and pension products than directly. That is why overall in Europe, the direct subscription of investment funds is very small. It's 7% or 8% of total financial savings of households, whereas life insurance and pensions is like 38%, 32%. So that was one thing we proposed. And the other thing we proposed was to consider and to study banning commissions, what you call inducements, on execution-only transaction, like it is done, for example, in Canada, because nobody, including the regulators, could tell me what is the value for service there to get a commission for, I don't know, 5, 10, 20 years, just because someone wanted one fund or one life insurance contract himself, he never asked any about advice, just executed the transaction on the platform. So I tried to be brief, but that is key. It is to curb down, to minimize conflicts of interest in distribution. And let me add one last word. I think it is the long-term interest of fund managers to do that, because you are not on the front line of this. As you know, first, you are not often distributors, you are manufacturers. Second, that is not where the bigger problem of commissions is. You have other products, more packaged products, for example, in life insurance and pensions, which are like the Big Mac, you know, they have double-deckers or triple-deckers of commissions and more opaque. So I think we should work together to minimize conflicts of interest in distribution.
Yeah. I can agree, I can fully agree. Two things.
Can I make
word?
just one word? No, just
because it said this disruptive thing. The distribution of securities and funds in the UK and in the Netherlands is not comparable to the situation in most EU countries. The system.
That's why I'm not even asking for a ban, Thomas.
It's
the
involvement of the banking industry, etc. So that is not comparable.
Gabriel, last intervention, please.
No, just to say that from my side, I would agree with those proposals. And actually, I think you know the political discussion that existed when there were adjustments on the IDD. From our side at EIOPA, we were much more positive on having alignment. The political decision in the council was to go back on that. So that was the reality. Yeah.
I know.
Thank you, Tanya. The retail investor strategy is foreseen for first quarter 2022. In 30 seconds, can you give us what will be the milestones? Any idea there? What can we expect in the coming months from the Commission?
I think yes. So I think you've already mentioned the study, and Guillaume did mention the fact that the high-level forum did recommend a study to look into specifically the topic of inducements and the role inducements play in distribution. So we're currently conducting a study with the help of external consultant that is advising us specifically on those questions. So the question of advice, the question of distribution, the role played by inducements, the suitability test, the relevance of suitability test across products, going back to what Gabriel said about simpler products and whether suitability tests should be aligned for simpler products as opposed to more complex products and things like that. So this is currently being assessed as part of this study. Now, we are hoping to get results basically by the end of the next year. And that would feed into the retail investment strategy that we announced for the first half of the year in 2022. Unfortunately, it would take a bit of time because I think the issues are very complicated. There are also national, I think, differences that need to be considered. I think we also shouldn't forget that I think on the average, Dutch people and British people are, I think, more or rather less, I think, risk averse and generally have more trust in capital markets, and that's there are data supporting that. And I think they are in general also better educated. So these are also, national specificities, or the kind of specificities that we would need to take into account when we are deciding on overall policy. So I think the main premise of the retail investment strategy will be about putting the retail investor in the center of capital markets, making sure that it's about this retail investor. It's about investors' journey. It's about, how can we make sure that, okay, whatever word we use, we engage, we support, we promote, but how do we make sure that we maximize value for retail investors? So it's not pushing retail investor because capital markets need it, but because retail investor needs capital markets. So that also goes in the direction of what we've just been discussing when we spoke about pensions. So this is going to be really putting retail investor in the center. And then as part of that, of course, the whole work on disclosures. And this is a very, very complicated topic, I'm afraid, because all of the sectoral legislations were discussed and agreed separately. That's why we've got a misalignment between MiFID and IDD. And just like yourself, I do not like it. I don't think it contributes to the level playing field. Actually, it's not a level playing field. It's not fair, but it's there because it was the result of the political outcome. And unfortunately, all of this legislation, because they were discussed separately, they resulted in different outcomes. So now I think it's high time.
Thank you. Yeah.
Before you even start on disclosure on sustainability, but
okay.
Exactly. That's another complication. That's another complication. But just to conclude, trying to align all of this and, going into, making it more understandable, simpler, fairer, whatever. I mean, getting only the necessary information there is going to be complicated, and aligning across all different pieces of legislation is going to be complicated. But that's one of the objectives that I think the retail investment strategy is going to pursue, and I hope we will be able to make progress and have another discussion maybe in a year or so, and then we can discuss maybe already on the basis of concrete proposals coming out from the Commission.
Thank you. I think that's a good conclusion. I'm sure there will be many further opportunities to discuss all those issues. By way of concluding remarks, I will just ask one question, and I would like each panelist to answer in one sentence. So the question to Tanya, Gabriel, and Guillaume is the following: what should the investment management industry improve, do, stop doing, or understand? And I just need one sentence. I will start by Guillaume, and then Gabriel and Tanya. Guillaume, one sentence, please.
Yeah, thank you. I would like the investment management industry to side more actively with their individual clients and other individual investors, to actively, for example, seek remediation on capital market abuses like Wirecard, on promoting access to simple and cost-efficient investment products. As I said, it's the long-term interest of the fund management industry, but also to educate them, and in particular against greenwashing. I was very concerned about Sheila's figure.
Yeah, so ESG washing.
Yeah, I'm stopping there, but I was very concerned about Sheila's survey, where we need to invest in sync with beliefs. What about facts and scientific evidence? Thank you.
Thank you. Gabriel, one sentence, please.
Well, I would like the investment management industry to embrace the PEP and really to develop and offer sustainable products, really truly sustainable products to the European citizens to improve their retirement income.
Thank you. Tanya?
I would like for asset management industry to think more about the value for the investor, about the investor's journey above all, and meaning thinking more about the products that investors need and not the products that make sense for asset managers to distribute.
Thank you. Now the question to Sheila, Thomas, and Guillaume again is the following: what should the policymakers and supervisors improve, do, stop doing, or understand? Thomas.
Create a level playing field in whatever you do concerning pensions, concerning the capital markets union, concerning inducements, etc.
Thank you. Sheila?
Get your heads around risk and the risk of not taking risk.
Thank you. Guillaume?
Don't kill the UCITS KRID as early as next year. Wait for the end of the full review of level 1. Please, for investors, would be unbearable for us.
Thank you. That's an excellent conclusion. So this is it. Thank you all for your participation. Thank you to all the panelists, to the audience, and to those who helped us prepare this panel discussion. We did receive quite a few questions, but actually a lot had to do with the PRIPS, UCITS, PEP, and financial education, and you addressed them all. So the conference resumes tomorrow morning at 9:30 CET sharp. Don't miss it. We have a hugely relevant program and a fantastic lineup of speakers. Check it out on the event platform. So talk to you tomorrow and have a nice evening. Bye-bye.
Bye-bye.
Bye.
Bye, everyone.